Welcome back to today's topic. Here with me, CJ Terra with ZSource Forex, where a pip a day keeps poverty away. So today we're going to talk about breakout strategy and how basically you can infuse that with your chart patterns. So we're going to talk about a few chart patterns that we did discuss yesterday. For those that didn't watch yesterday's video, I'll link it in this one so that you can have a look. So basically we did discuss several chart patterns, like when the market is at an uptrend, it makes high highs, high lows. Okay, if it's in a consolidation, it will make equal highs, equal lows, stuff like that. Then if it's in a downtrend, it will make lower lows, lower highs, lower lows, lower highs, something like that. Something like that. Okay, to print those patterns. Then you also have, out of these, there are several ones that you'd also look at, like a triangle pattern, something like this. Okay, then you'd also have what we call a falling wedge, market comes down, something like this, or some would call it a bearish flag. Okay, you can do some ample research. There's a lot of information out there about what these are. Okay, so for those that don't know, so how do you now talk about the breakout? Because all these patterns are formed on different time frames. You could have them on a 1 minute, you could have them on a 30 minute, you could have them on a 1 hour, daily. It's just dependent on exactly where you're looking at, and how you trade that is dependent on which time frame this pattern has shown. Okay, has shown up. Remember guys, you have to keep it simple. Always understand first what direction the market is going to, where the market is coming from. It is very important that you do, because if you don't, you end up trading things that you don't understand. Okay, but once you have a clear perspective of the direction, you have the zones, now you wait for the candlesticks to tell you exactly what the market is doing. Is it going to continue in the anticipated move that you anticipated, or it's gonna go in a different direction? So all these patterns can work with what we call the breakout strategy. What that means is that when the market either is in a consolidation, you as a trader, either you don't trade consolidation, as I always recommend. You can either wait for a breakout of structure from its channel, this is what it is forming. Okay, and once it breaks out, what do you wait for in order for you to take a trade? So for example, this market is consolidating. So from here we have a breakout of the norm, where the market has usually been failing to break the equal highs. It has been failing to break those, and finally it breaks out. My recommendation is, you once it breaks out, don't take a trade immediately. You wait for that retest back into this zone. Then if it shows you signs that it's gonna continue to the upside from here in this zone here, then you are free to take a buy signal or a buy trade. Okay, reason why we wait for the retest, there's a lot of fake out that can happen in the market. So you have something like this. Okay, always go for 1:2, meaning if you're risking $10, you're looking forward to make a $20 trade. Okay, or 1:3 if you desire. So this is how you trade a consolidation. You wait for a breakout above to take your buys, or a breakout below to take your sells. The market might come back here, retest, then continue to the downside. Okay, so once you have that breakout and it has shown you signs of candlesticks showing continuation in this zone here, then you can take it yourself to the downside. Okay, same applies with all these other structures. If the market breaks out of the norm of the channel, let's say this one, the market is moving up, then it comes up here, retests this zone and shows signs of continuation to the upside, then what do? You can set your buy there in that zone. Okay, so remember, the final piece of the puzzle is the candlesticks. Same applies to all these other patterns. You wait for a breakout if you've noticed that the market is no longer respecting these zones that the market has been playing. So now let's look at a practical example. Yesterday we were looking at Nasdaq. This is on a 4-hour time frame. We did have a structure like this. Okay, this was the initial structure that we had. Okay, as you can see, this is what we call a bullish flag pattern. Okay, what that means is the market is coming down here, then it's consolidating in here, then there's a possibility of it breaking out. And yesterday's move, we did move to the downside a bit to fake out a bit of people, then now it has gone all the way up. So we are stuck now in this area. Okay, once we wait for that retest in this zone here, if the candlesticks allow to say yes, this is gonna be a continuation buy, then you can take your buy position in this area. Okay, your stop loss will be somewhere below the zone. Okay, and you go for your 1:3, okay, or 1:2, depending on what you prefer. But this, since it's being a higher time frame, you can even swing this trade all the way to these highs up to here, somewhere there. Okay, so but always remember, risk management is key. Once you are aiming for a higher target like this, make sure you are moving your stop losses in profit as the market goes a long way with you. Okay, this is a practical example that I can give you. For those that didn't watch the previous video, you can just see the link below, then it will take you to that previous video. Otherwise, if you have any questions, feel free to ask in the comment section. Thank you for having me. Remember, a peep a day keeps poverty away.